All right, the topic for right now is going to be the foreign exchange market. Now, I know we talked a little bit about Forex on the presentation from previously, but it didn't really go into the sort of detail that we need for AP macro purposes. So I want to talk about a foreign exchange market exclusively. All right, now, Forex, or the foreign exchange market, a lot of times you'll just hear it abbreviated this way, Forex. Now, what the foreign exchange market is this is the market in which currencies are bought and sold, where they're traded. Now, let's say that you're going to be going to France, right? You want to see the Louvre, les Champs-Élysées, you want to buy les baguettes à la boulangerie, and speak with an outrageous French accent. All right, now let's say you're going to go there. Well, what do you need? You need euros. How are you going to get them? Well, chances are, before you go over there, or soon afterwards, you're going to go somewhere where you can exchange the currency. Maybe you'll go to a bank, maybe you'll go to an exchange kiosk, and you're going to give them some dollars, and they're going to give you a certain number of euros. Okay, well, what determines how many euros you're going to get for the dollars you have? The answer is going to be the exchange rate. Okay, great. But what determines the exchange rate, right? What determines how many dollars you'll get for euros and vice versa? The answer is going to be supply and demand, just like anything. Okay, so just like you have supply and demand for products, you have supply and demand out there for currencies versus each other. All right, so what we have are a couple of corresponding supply and demand graphs. All right. So let's say this is the supply and demand for dollars, all right? So euros per dollars. You have demand for dollars and you have the supply of dollars. And then over here you have a market for euros. Okay. So this is the market for dollars on the foreign exchange market, and this is the market for euros on that market. All right. So what determines how much they're worth compared to each other is supply and demand. How much are people trying to get rid of that currency, which would be supply, versus how much are people trying to get a hold of that currency, which would be demand. All right. So when the currency is less desirable, you're going to see more supply. When the country is more desirable, you're going to see more demand. All right? Okay. So in our market right here, we have two corresponding graphs again, supply and demand for dollars and supply and demand for euros. And think of this as being like a foreign exchange market. Think of this as being like a physical place, right? So there's an actual physical store out there called the FOREX, and people go in there and they buy and sell currencies. You have some people who walk in trying to sell currencies. You have other people who walk in trying to buy currencies. All right, and you buy one currency with another one, effectively. Okay, so in the market for dollars, what we have is the product, which is dollars down here, the quantity of dollars, like what you would see in any sort of product, right? This was supply and demand for Dr. Pepper. We're talking about quantity of Dr. Pepper. Here we're talking about quantity of dollars on the Forex. And then this is the price. All right, again, like in a supply and demand graph for Dr. Pepper, that'd be the price of Dr. P. This is the price of the dollar, the price in terms of euros. All right, how many euros does it take to equal $1? All right, so the price of the dollar in terms of euros. Easy way to remember this, if you have to draw one of these graphs or be able to manipulate them, what's on the bottom here is going to be on the bottom there. What's on the bottom here is going to be on the bottom there. All right, so a quantity of dollars is here on the x-axis, so dollars will be in the denominator on that y-axis, right? So we're comparing euros to dollars. And then over here we have a corresponding graph where we're talking about the quantity of euros on the foreign exchange market. All right. And the price of the euros is being given in terms of dollars. Again, euros is on the bottom here on the x-axis, so it is in the denominator there on that thing on the y-axis. What is the price of the euro in terms of dollars? Now, in our scenario, we said they're going to be traveling to France. So, in order to do that, you need to trade in your dollars for euros. So, you're walking into that foreign exchange market, right, into that physical store with a fistful of dollars, and you're trying to sell them to somebody else, all right? So, what happened in the market for dollars is the supply of dollars increase on the foreign exchange market. Okay, you walked in with more dollars, you're trying to get rid of them, you have supplied more dollars on the Forex, all right? There's more dollars out there to be sold. And when that occurred, what we see is the exchange rate falling. Dollars are not worth as much because you're trying to get rid of them, all right? We call this depreciation. Depreciation is when a currency becomes weaker versus another one. All right? Depreciation is when a currency becomes weaker compared to another one. So in this case, the dollar is depreciating compared to the euro. It's becoming weaker. It's not worth as much. All right? You won't be able to get as many euros per dollar in this scenario. Now, what we have corresponding in this other graph is you're trying to sell your dollars at the same time as you're trying to get euros. Right? You're trying to buy euros in this market. So the demand for euros is increasing because that's what you're trying to get. You're trying to buy. All right? So here we see the demand for euros has shifted to the right. There's a bigger demand for euros. That's a shift to the right. And just like we see in any other supply and demand graph, that means the price goes up. In this case, we call it the exchange rate. The exchange rate has risen. All right? We call this appreciation. So in this case, the euro has appreciated compared to the dollar. It has become stronger compared to the dollar. All right? You don't need as many, fewer dollars, or excuse me, more dollars that equal 1 euro. All right? Over here, when the exchange rate fell, you need fewer euros to equal $1. All right? So this means the euro has become stronger, the dollar has become weaker. So when we look at foreign exchange markets, this is the phenomenon that is going on, right? It's a matter of supply and demand. An easy way to think of currencies going to be appreciating or depreciating, you can do the graph, and in some cases you might have to, but the easy way to shortcut is just think to yourself, is this scenario going to make the currency more attractive or less attractive? Will people need or want this currency more, or people need or want this currency less? Okay. Now, in the PowerPoint, we're going to be going through some scenarios where we see this going on, figuring out if it's going to become more or less attractive. All right, so I'm going to pause it real quick and come back. All right, so foreign exchange market, Forex, all right, exchange rate, relative price of currencies. Now, this has to do with imports and exports, right? So if you're going to be selling goods across countries' borders, right? So if you're going to be exporting goods or importing goods, you need the other country's currencies, right? So if the U.S. sells cars to Mexico, then the Mexican sellers are going to be buying cars from the U.S. If they're going to be buying cars from the U.S., then what they need is dollars, right? Because the American companies don't accept pesos, so the pesos will need to be converted into dollars, right? If Mexico buys tractors from Canada, again, Canada isn't going to accept the Mexican pesos. The pesos will have to be exchanged for Canadian dollars, right? Canada sells syrup to the U.S., Canadian dollars have to be converted into U.S. dollars. Japan buys fireworks from Mexico. Japanese yen will have to be converted into Mexican pesos. All right? So we say converted, but really it's going to be is selling one currency and then buying another one. Okay? So different national currencies, different values of them compared to one another. All right? Have to be paid in the currency of the home country from which the goods are being bought. There was a point in time where there were fixed exchange rates, and those had to do with the gold standard and stuff like that. That doesn't happen anymore. We're on what's called the floating point exchange rate, which is going to be where currencies are valued compared to each other based upon supply and demand of those currencies in the foreign exchange market. All right. There's a couple of weird ones out there where they're pegged to the dollar or to the euro, but we're not going to worry about those. All right. So in all these scenarios, the buyer or the importer must exchange their currencies for that of the seller. So you have currency codes, and right, these aren't terribly important, but each one of them has this little 3-letter code down, right, for the US dollar, USD. All right. This is an example of an exchange rate table. All right, so you want to have these for all sorts of different currencies. This is showing you the exchange rate for the dollar for all these other ones, right? So you see it right here, US dollar to the foreign currency. So this is a fancy way of saying 1 US dollar is equal to 0.7335 euros. And it's equal to 91.67 Japanese yen, and $1 is equal to 0.6459 British pounds. All right. So how would you read this? Well, let's say that I need, I've got myself $1,000. I'm going to cash it in for euros. How many euros will I get for $1,000? Well, I would get 733.5 euros. Right? So it'd be 1,000 times 0.7335 will give you the answer. All right? That's how many euros I would get for 1,000 US dollars. All right? Over here, this is the foreign currency in US dollars. So this would be euros per dollar, right? Or excuse me, dollars per euro. So 1 euro is going to be equal to 1.3634 US dollars. So if I had 1,000 euros, how many dollars would I get? I would get $1,363.40, right, in exchange for my 1,000 euros. You take the amount of the currency you're converting into, multiplied by that exchange rate. There you go. Okay. So we look at these 2 country currencies at a time. We're not going to be looking at 3 or 4 at a time. You compare 2 of them, right, such as what we did in our little supply-demand graph. We looked at euros and dollars. All right. Let's say in these scenarios, we're going to be using US dollars and British pounds. So we examine the price of one currency and compare terms of the other one. So $2 equal to 1 pound. All right. So, et cetera, the price of $1, 1 US dollar in terms of British pounds is like that, right? So 1 pound goes equal to $2. So 0.5 pounds. All right. And then 1 pound in terms of US dollars, $2 per British pound. Yep. So we talked about the exchange rate and all that stuff. Let's say that we went from $2 is equal to 1 British pound to $5 is equal to 1 British pound. Okay, so what happened here is the dollar depreciated. In our supply and demand graph, it could be the demand decrease, it could be the supply increase, whichever way, the dollar has depreciated. Okay, it's become weaker because you need more dollars to equal 1 British pound. Previously, you needed $2 to equal 1 pound. Now you need $5 to equal 1 pound. You need more dollars to equal that same 1 British pound. So that means the dollar has become weaker and it has depreciated. All right. So loss of value of a country's currency with respect to a foreign currency, weaker. All right. Need more of that currency, in this case dollars, in order to equal 1 of the other person's currency. All right. All right. So if it goes the other direction, before we needed $2 to equal 1 British pound. Let's say we need $1 to equal 4 British pounds. All right, this has been appreciation. Right, you need fewer dollars to equal even more pounds than we did before. Right, and this exchange rate, $1 is equal to 4 British pounds. Right, so it'd be 25 cents would be equal to 1 British pound, right? Where before you needed $2 equal 1 British pound, now you would need just 25 cents. Okay, so you need fewer dollars to equal the same number of pounds as before, so this would be appreciation. The currency has become stronger compared to what it was previously versus the other currency. Okay, so we've seen this, right? We kind of did this on the previous bit, so I'm going to motor on past it. Okay, and we talked some about the exchange rates. Now, what causes supply and demand to shift? All right, these are going to be the things that cause supply and demand to shift within the foreign exchange market. So let's say that you have changes in taste, right? For an example, British tourists decide to flock to the U.S. If British tourists are coming to the U.S., what do they need? Well, they need dollars. So they're going to cash in their pounds for dollars, which would mean that the supply of pounds would increase on the Forex and the demand for dollars would increase on the Forex. Okay? Pounds are less desirable, dollars are more desirable. So what would happen? Well, if the demand is increasing, supply is shifting to the right, just like in the supply and demand for anything. If the demand is greater, that means the price goes up. The demand for dollar is increasing, the price is going up, which means the dollar is appreciating versus the pound. All right? And the supply of pounds is shifting to the right, it's increasing. There's more of them, less desirable. So that means the pound is going to depreciate, right? It's going to become weaker versus the dollar. So changes in taste, for whatever reason, all right, one currency is becoming more desirable than another one, could be tourism or something like that, that will cause a shift, all right? Changes in relative incomes. What's happening here is that for whatever reason, one country is having an increase in income. Maybe you have the United States, in this example, is experiencing a very good economy, so that means incomes are going up. What happens when incomes go up? People buy more stuff, and one of the things they'll buy more of is going to be imported goods. Now, if you're buying more imported goods, what does that mean? It means that you have to use more of your dollars and convert them into the other country's currency, all right? So dollars are going to be sold, right, gotten rid of, and be converted into pounds, which are now more desirable, because we need the British pounds in order to be able to buy the British goods. Okay, so higher incomes means you'll import more, which means the supply of your currency will increase, the demand for the other country's currency will increase, and we'll see the associated changes in the exchange rate. Okay, so supply of US dollars increases on the Forex, the demand for pounds increases. A bigger demand for British pounds means appreciation is becoming stronger, right? They are more desirable than what they used to be because people are buying more British imports. Right? At the same time, the dollar is becoming weaker compared to the pound because the supply of dollars on the foreign exchange market is increasing, which is causing depreciation. All right? Remember, these always go in opposite directions. All right? If one currency is becoming stronger, that means the other one is becoming weaker. It's of necessity. Right? They're talking about two things relative to each other. One becomes stronger, the other one must become weaker. If one becomes weaker relative to the other one's becoming stronger. All right, so changes in taste, changes in relative income will affect the Forex. Changes in relative price level. This has to do with inflation within your own country. So in this scenario, let's say the U.S. prices increase relative to Britain. What that means is the inflation rate is higher in the United States than it is in Britain. And you'll see AP questions that will phrase this in different ways. They'll say price levels are increasing in one place, or they'll say that inflation rate is higher in one place than it is in another one. All right, so here the inflation rate in the U.S. is higher than what it is in Great Britain. All right, so what's going to happen? Well, think about if you're American, and I'm assuming you are, if inflation rate is higher in the United States, that means that things are more expensive in the United States. What do you want to do? You want to buy the comparatively cheaper stuff from Great Britain instead. All right? So you will start buying more of the British stuff, and if you buy more British stuff, what do you need? You need British pounds. Okay? So you'll be cashing in your dollars and buying the pounds. So what's going to happen? Supply of US dollars increases, the demand for pounds increases. As a result, the pound appreciates. It is now more desirable because the demand is shifting to the right. Okay? And at the same time, the dollar depreciates because the supply of the dollar on the foreign exchange market is increasing. People are supplying more dollars, getting rid of them in order to buy pounds so they can buy more of those British imports. Okay. Fourth thing, changes in relative interest rates. What are interest rates like in one country versus another one? Okay. So money will chase higher interest rates. The reason being is that people want to save their money in places where the interest rates are higher. Okay. So in number 4 here, the example is the United States has a higher interest rate than Great Britain does. If the U.S. interest rates are higher in the United States, that means that British people want to save their money more in the United States than what they do in Great Britain. And also Americans are more likely to keep their own money in America versus trying to save it in some other country like Great Britain. So British people want to put their money in U.S. banks. Capital flow, or in this case financial capital, money, flows in towards the U.S. Well, if British people want to save their money in the U.S., what do they need? They need dollars. So the demand for U.S. dollars is going to increase. At the same time, the supply of pounds will increase because they're trying to get rid of pounds and buy U.S. dollars. So the dollar has a higher demand. It's more desirable. It'll appreciate, and the pound will depreciate. All right. You can also look at this in a different way, where you could say that the supply of dollars will decrease in the Forex because Americans are more likely to keep their money at home. Well, that would cause the appreciation. All right. And the demand for British pounds would decrease because Americans aren't going to be buying pounds to save in Great Britain, so that could also cause the depreciation of the pound. All right, so let's practice a little bit. Here's the following examples here. Right, I'm going to look at these. I want you to pause it after bringing up all 7 of them. All right, pause it and answer for yourself. What's going to happen to each one of these? All right, so in scenario number 1, American tourists increase visits to Japan. Will the U.S. dollar appreciate or depreciate? And will the Japanese yen appreciate or will it depreciate? Right, and try to think about why that would be the case. Why one's going to appreciate and the other one will depreciate. All right. Did you pause? I hope you did. Answers. All right. In the first scenario, the dollar will appreciate and depreciate. I'll just go through all 6 of these here. All right. All right. So here are all the answers. If you want to go through any of these, happy to do so. Ask me in class. We might even just go through them as a matter of course at some point. And that's it for Forex. Okay, next thing we got to worry about is going to be balance of trade, which is a little bit weird, but it makes sense once we start getting into it.